were not able to finish their terms or extend their terms made compromises. At some point, you have to draw a line. We made an honest attempt. We resisted the pressures that were coming on our way. I understand you have to act fast, but you also have to act right. We don't debate these issues, which we are facing government after government after government. And I'm glad we did it. I would do it all over again.
Right.
So I'm not saying you meet my targets. I'm saying you meet your own targets. Public servant is a servant of the public. I'm not a servant of the bureaucrats nor of the government. That the pressures coming from the bureaucracy and the government are in their own vested short-term interests. That meeting after meeting, the disinvestment ministry would say, yes, we are going to disinvest. And that time, they don't want to follow any rules.
Hello and welcome. You're watching this special discussion on the New Indian Express channel. Joining me in the conversation today is Dr. Acharya, former Deputy Governor of the Reserve Bank of India. Also with me is G.S. Vasu, editor the New Indian Express, and business editor Jayanta Roy Chaudhary.
What, in your view, are the three fundamental problems that the Indian economy currently faces?
I think in terms of the current challenges, I would say first and foremost has to be the virus curve. I think unfortunately it has not been relenting. While there are signs of stability in certain portions that have been the key hotspots so far, I would say these are still early signs of stability. Nevertheless, new hotspots are emerging elsewhere. I've been quite concerned for a while about the fact that the Indian curve continues to rise rather than showing signs that it has actually peaked in some way. I think bringing down the curve, flattening it as soon as possible, without having very extreme consequences on economic activity has to be the first challenge that we face. I think it's a short-term challenge. Second, if I could turn a little bit to my book, Quest for Restoring Financial Stability in India, I do think that perhaps the most important primary challenge for policy right now is how to create fiscal space to accommodate the expenditures that may be necessary to support growth in the COVID and the post-COVID phase. The fiscal is very stretched. It has been stretched for a while. It hasn't been adequately discussed as openly as one would like. And I think that has put us in a situation where we are unable to decisively take on certain critical expenditures and reorient expenditures in areas that might be necessary in order to help revive growth. So figuring out a way to undertake these necessary expenditures while at the same time maintaining debt sustainability in the sense of giving credibility to markets, to rating agencies, that we can actually stick to medium-term targets once we lay them out, I think is key, and we can discuss what may be some ways of achieving that. And third, at a slightly longer horizon, but maybe not much longer than the immediate fiscal needs, is the issue of financial stability. As Reserve Bank of India's recently released financial stability report has shown, the numbers on non-performing assets on banks and NBFCs are likely to actually grow to probably 15%. Many analysts are projecting even higher numbers if the contraction actually reaches double digit in terms of GDP growth. I think this is not going to be easy to deal with, and there is only one way out in my view, which is that in the present buoyant circumstances of the equity markets, where both the domestic flows and the foreign flows are actually good, banks, NBFCs, they need to go to the market, raise capital and preserve it in their balance sheet to absorb the losses. Public sector banks can either get a direct infusion from the government, or even better, in my view, they should be allowed to divest their stakes very significantly below 50%. If necessary, perhaps even reprivatization of some of these banks may have to be put on the table.
A lot of predictions have been made in regard to the contraction of GDP, ranging from 5% to as much as 15%. What, in your view, is a reasonable guess as to what the contraction could be? Are you sure it will be double digit?
I think some of the analysts whose reports I have tracked more carefully seem to suggest that it is likely to be in the 5 to 10% range with a high probability. And they are doing some very simple heuristic calculations that if you basically lose 4 to 6 months of economic activity, that simply has to translate into a number of correction, which is on the order of that magnitude. And the reason why I have liked their approach is because in a fog of uncertainty, by and large, it is simpler calculations which are often actually the right direction to put more weight on rather than doing very complex aggregations across different sectors of the economy. It's true that the rural economy and the farming are doing well, but that is a relatively small proportion of India's GDP at the present state. Services is very large, and that's where there has been a huge hit in terms of the collapse of economic activity. I think coming back to your first question, if I could combine the two, is that to me, from a financial stability, macroeconomic stability standpoint, what matters are not the average paths. What is your average expectation of growth recovery? What matters is some stress scenario where we might end up, because you have to have an economy that is resilient to that stress scenario. And I think the stresses right now, the stress scenarios are more likely than what ordinarily one might think, because COVID is not just something that's affecting India, it is also actually affecting the rest of the global economy. The COVID has accelerated certain difficult trends that were already emerging in the global economy on the front of trade. Now, how the trade war plays out, how those geopolitical tensions, what shape they take, will they lead to a dramatic reformation of global supply chains? On the one hand, it could be an opportunity for India. Nevertheless, given our imports, it could also be a potential cost. And I think I think I would say that not only is the growth likely to be in the contraction region, 5 to 10% looks highly likely as a contraction. But more importantly, I think we have to entertain that there is a fair bit of uncertainty around that path.
When you talk about resilience, can you identify 2 or 3 key steps that need to be taken right away?
I think the first and foremost, I would like to say that the Reserve Bank of India's financial stability report needs to be taken extremely seriously. These reports over a period of time have shown to be prescient about the upcoming stresses, and partly because it's a very objective look on the economy. It's not a direct decision making that goes into like deciding what the asset quality recognition norms are. The job of this group is to warn about the potential stresses, and therefore they do get things right because they're collecting information from a variety of different sources. The fact that for the first time they are projecting potential gross NPA ratio that's on the order of 12.5, 15%, suggests that we do need to take the capitalization of the financial sector very seriously. My preference would be if at a minimum, the stress test, which is in the financial stability report, is used as a bank level metric for how much rupees of capital needs to be raised by each institution. This can even be applied to non-bank financial companies, in my view. Second, I would say the resilience point has to be on the fiscal front. Even if the fiscal expenditures are not expanded to take care of the situation we are in, the debt to GDP numbers are likely to rise simply because tax collections are likely to come down.
Yes.
So there is a revenue hit on the fisc, even without actually expanding on the expenditure front. Now, you can very quickly do a series of calculations, as many analysts are doing, to get a sense of over a period of 3 years, over a period of 5 years, under different protracted growth paths, what sort of debt to GDP numbers are likely to arise. And we need to do this kind of scenario analysis because we need to ask ourselves the question, at what point do the debt sustainability analysis is pointing towards reaching Reinhard Rogoff style of 90% plus debt to GDP numbers. We need to not reach that point because the only way you can maintain those high debt to GDP ratios without creating market stress is if you are already on a very phenomenal growth path. Uh, Whether we like it or not, we are not yet a safe haven currency. We are not going to be flooded with inflows when the stress materializes. I think this requires, in my view, and this is a contrarian view to what a lot of economists and senior, even sort of former RBI top management are saying, I think we cannot put these concerns aside. I think we have to plan for them now. These are the types of moments when the politics and the economics for fiscal reform become fully aligned, because the government wants to spend. Clearly, the government doesn't want to face debt sustainability concerns in the markets, because that could be a full-blown problem. So this means politics and economics are aligned right now. This is a golden opportunity to restructure our institutions for fiscal, in my view. This means transparency, not just above the line, below the line, inside the balance sheet, outside the balance sheet, before 31st Jan, after 31st Jan. Truly transparent fiscal accounting. Second, readherence to the FRBM norms over medium term. We have seen that just announcing that these are the norms doesn't help. You have to adhere to them. So you do need an institution that provides a mirror on the fisc on what your adherence path is. I think we truly need a bipartisan independent fiscal council, the way it was advocated in the 14th Finance Commission. Dr. Reddy talks about this in his foreword, and of course he was the chairman of that 14th Finance Commission report as well. Unfortunately, those 2 pages of the 14th Finance Commission have been largely ignored. The FRBM targets have been set as targets without an institutional mechanism that can help adherence to the norms. And I think we need to put in place this institution. And finally, I would say that India benefited tremendously from the disinvestment programs that were undertaken implicitly in the 1991 reforms through liberalization of several sectors. So you allowed new entry. That's like a backdoor disinvestments, in my view, of a repressed sector. And second, there were also massive disinvestments during 1998 to 2003 period. And I think those were, in my sense, the golden era of our post-1991 reforms. I think this is a moment where that golden era can be created again. Because the politics and the economics is aligned, I think we can undertake very substantial disinvestments. And I would push it in the direction of reducing the government stakes in the financial institutions, public sector banks, insurance companies to below 50%. I think you can look at Southeast Asian crisis. This was forced upon these countries in the midst of the Southeast Asian crisis. They had to incur 50 to 70% of GDP costs to mop up the financial sector. And the only way to reduce the burden was to allow foreign entry into the financial firms, banks, and others. We don't need to wait for that kind of scenario. It would be much better to do the disinvestment at the healthy prices that we have in the markets right now. Because doing it when you are on the cusp of a debt sustainability concern would mean you would have to do fire sales at that point of time. So I think this would be a perfect time to create another golden era of a disinvestment program. I would say even full reprivatization should be on the table in some cases.
You have been talking about what Dr. Reddy recommended and all that, the bipartisan thing. So you have been with the RBI, right? Which are the vested interests that are blocking it, if I may use that expression? Why is it not being done? Is it that we are worried more about the stock market than the Indian economy?
The vested interest is really what I'm trying to highlight throughout the book, and especially in my Eddie Stroff memorial lecture, which is that government horizons can become very short at certain points of time. And that time, they don't want to follow any rules. They want to have the discretion actually to extend credit quickly, to be able to borrow, even if that means some amount of short-term risks in the process. Because if the horizons are short, they will say, let's first get over this initial hurdle and then I'll worry about the flood afterwards. Let me just open the taps right now. And that's why I think sometimes there isn't movement for these reforms from either side, neither from the existing government nor from the other side, because they all want these things available to them when they are in their particular situation. At times, you need public opinion and debate to galvanize towards what is right for the economy in the long run. We can't just expect that right institutions for the long run of the economy will just come about on their own. In fact, I view my book as an attempt to actually raise a public debate on these issues so that collectively we can decide, is this an important institution we want to have? We have voice. We can write about it. We can get people to discuss this in panel debates. And I'm hoping that the fiscal institutional reforms that the country needs, which are not just relevant because of the COVID outbreak, in my opinion, they are relevant even for financial stability, because otherwise the pressure is always to dilute the banking norms, that we need a much more open and transparent debate about the fiscal situation and why we need institutional reforms to be put in place. Because I think on their own, each government would like to have the discretion to do what it wants when the short term pressures arise. But right now, I think the politics and the economics may have a right juncture because of the COVID outbreak.
Do you mean to suggest that when someone is at the RBI, either in the position of the governor or the deputy governor, you are not entitled to make these things public and thereby generate a debate?
In my opinion, that should not be so. I think the Reserve Bank of India or any central bank in the world has to factor in fiscal as a very important macroeconomic precondition for stability. So there should be a much more open debate. Nevertheless, I think the practice of central banks, not just in India, but the world over, is that the central bankers do seem to think twice before making a comment on the fiscal, because that could be interpreted as doing an overstretch beyond what's your immediate mandate. And then there could be difficulty of working on a day-to-day basis in a manner that you would like to preserve your operational autonomy, etc. Nevertheless, in my view, if the fiscal is not in shape, there is pressure on all policies of the central bank to gradually start getting dominated. This is the theme of the core new introductory chapter of my book. This is, in fact, my summary of what I thought was the real problem at the end of the day, which is that the fiscal dominance was creating a pervasive pressure on all the policies of the central bank when the government horizons became very short term. At that point of time, because financial stability could be endangered, because the mandate of the central bank is to protect the depositors, protect the banks, protect the inflation credibility, protect the external sector, I think the central bank must raise its voice. I did write a speech about this during my term, which was released only on the day before I left, and it was not released as something that the central bank supported. It was released as my own independent view. So in my view, central bankers should speak. I did speak. I did raise these debates internally, and I did write a speech about it. And I think more central bankers, not just in India, all over the world, need to actually raise questions about the fiscal math that is at play right now.
No, I do appreciate all the points that well-meaning former governors are raising now. But in the context of what you said, in one sense, they have failed in their duty when they were holding the office.
I haven't been a governor, so I don't know.
No, I'm not talking about you. I'm not talking about you.
No. What I was trying to say was that, I should not hazard a guess that I fully understand the pressures that are on them, because there is a big difference between being on the 19th floor and being on the 18th floor of the Reserve Bank of India. Nevertheless, I view it more as an issue of democratic accountability.
There can be a healthy difference of opinion, right?
Yeah, exactly.
It may not be necessarily a matter of friction between the Reserve Bank and the government.
Absolutely. And I think you will see that central bankers who have conviction on this front, in my introductory chapter, I refer in a footnote to Paul Walker and his biography that one of my colleagues, former colleagues, Bill Silber, wrote. Paul Walker explicitly defended against monetization of the Reagan era expansionary manifesto. He didn't even have the institutional framework at that time. It wasn't like FOMC meetings had a calendar, they had to be formally announced. It was a slightly informal arrangement between the central bank and the government at that time. But he explicitly resisted the fiscal pressures that were pushing him to keep interest rates low in order to reduce the rollover costs of the government, because he said, no, I have just reined in inflation. And the reason why the long-term bond yields are rising is because your expansionary manifesto is being seen as fiscally too aggressive by the government. And having just arrested inflation from double-digit levels, I cannot sacrifice the gains that we have just achieved for the macroeconomic stability of the economy. And in the end, he prevailed. He actually managed to succeed against this. Now, he did not make a public debate of these issues at that time, but it is very clear from the people who knew about the debates at that time that Paul Walker hadn't walked the line that the Reagan administration wanted him to walk. I think this is a great example, in my view, of a public servant putting macroeconomic stability ahead of the immediate pressures that were coming from the fiscal arithmetic. I read your article yesterday, and you have written about why some of us, like Governor Patel, Governor Rajan, and I, need to find out ways of dealing with the bureaucrats and getting that in the line. I think it's a good point. Many people think I'm an impractical person. My sense is on certain issues, there can be no compromise, because you know that the pressures coming from the bureaucracy and the government are in their own vested short-term interests. I think a central bank is run by public servants. They have a legal constitutional mandate about what their objectives are. Some of us take this legal mandate very, very seriously. If we are asked to protect the interest of depositors, if we are asked to protect the interests of the banks in the sense of financial stability, if we have to protect the external sector, I think that is the mandate. If I am charged for interest rate decisions by maintaining my target interest rate, my target inflation levels at 4%, that's my legal mandate. I'm accountable to the parliament if that mandate is not violated. So all that I'm saying is that I don't think saying no to the government or the bureaucracy, or not being able to reach a compromise, means that we are not flexible. I don't think that's the right interpretation. I think all governors, including the governors who were not able to finish their terms or extend their terms, made compromises. But what happens in a period of short-term horizons of the government and bureaucracy is that every compromise that you make today becomes the starting point for a renegotiation tomorrow morning. And then you know that the pressures are getting unrelenting. And then at some point, you have to draw a line. Because I think I stress this, a public servant is a servant of the public. I'm not a servant of the bureaucrats nor of the government. The ultimate objective is to serve the people of India, and you have to do what in your calculations and given the legal mandate of the RBI is the right decision at a given point of time.
We've been talking about, for instance, fiscal deficit, how India's debt levels have been pretty high for several decades. Overhauling that, or reducing that in a very short time is very difficult, because governments also have several mandates. Indian budgets for the past several decades, 90% is more or less similar. So how do you expect that debt levels are reduced in a medium term? When you say medium term, it's 3 or 5 years. When we are seeing Indian budgets which are 90% similar all the time, how can we assume that FRBM targets are met in, let's say, in the medium term of 3 to 5 years?
What we have seen is that, therefore, it is really not about any specific governments. We have the same composition of our budget expenditures year after year after year. So what must be lacking is that either we don't have the right incentives in place, and I would like to think, as I've been repeating, that all governments face various mandates and short-term pressures at any given point of time. What you want to achieve, nevertheless, is that the economy reach the right long-term path in spite of these short-term pressures. For that, you need institutional mechanisms in place. So the flaw, in my opinion, has been not that we had FRBM targets. Clearly, you need to have these targets to build credibility with investors, but you needed an institutional mechanism in place which would aid slippages that become persistently away from these targets. And I think that mechanism, as advocated in the 14th Finance Commission, was the Independent Fiscal Council with transparent accounting, approval of the budgets before they are actually announced. Because, if a budget is saying I'm meeting the targets based on extraordinary growth assumptions, clearly that's not a reasonable budget to start with. That's something that should be vetted by an independent council. There are ways of generating revenues other than taxes, because the government owns still a very large quantity of assets in our economy. Unfortunately, the disinvestments have become a cosmetic trick. You sell one arm of a nationalized oil company to another arm. Ultimately, that one arm is borrowing in the markets in order to make the acquisition and pay a dividend to the government. So the public sector borrowing, the requirement hasn't been coming down as a result of the disinvestments. So if we did genuine disinvestments, which is that instead of raising debt in the markets, you actually raise equity, that's a very powerful tool that can be deployed by the government. And in fact, the former Niti Aayog chairman, Arvind Panagaria, has noted that meeting after meeting, the disinvestment ministry would say, yes, we are going to disinvest. But when it comes to do the actual disinvestment, we are always falling short of the budgeted targets that are out there. So I think we are cutting too much slack on the system by saying that, oh, we can't meet these targets, because they are not even meeting the targets that are set in their own budgets. Right. So I'm not saying you meet my targets. I'm saying you meet your own targets. Okay, if you have set a disinvestment target in your budget, meet it honestly, because you said at the beginning of the year that you were actually going to make these disinvestments. And equity markets in India have been so buoyant. Look at the flow of domestic savings that through the SIP channel is going into the markets. Even post-COVID, both through reversal of foreign flows and the domestic flows, the equity markets are now within 10% of the peak that was actually reached. What better time can there be? One reason why I am raising the fiscal scenario as being very crucial to India's macroeconomic stability is because I'm making, in my view, a very strong case that this has affected the financial stability of the country. The reason why adequate capital never gets into the public sector bank balance sheets is because the fiscal is always so stretched.
You mentioned about a couple of things in the banking sector. Banking consolidation is one. Then we've already initiated a cleanup exercise. And then banking reforms, the governance structure, won't that affect the credit growth as such?
First of all, there is no evidence that better capitalized banks don't lend. And any evidence is exactly the opposite. It is undercapitalized banks where the managers, the MDs get very risk averse. They start worrying about whether to do correct asset quality recognition or not, because otherwise my bank may actually require more capital from the government. I may not get the promotion to a larger public sector bank that I need, and so on. So there is no domestic or international evidence that requiring banks to be well capitalized actually reduces credit. If anything, it is the better capitalized parts of our financial system that are actually doing the credit growth. Just look at last 5 years. It is our better capitalized private sector banks that have had the lion's share of credit growth rather than our undercapitalized public sector banks, in spite of having greater deposit stability because of the public guarantee that we have out there. Second, I have a quote of the former Federal Reserve Chairman Janet Yellen in the last part of my introductory chapter, that once you have a large legacy bad loans problem, usually that's a sign that the system had fragility in the quality of the underwriting standards, in the risk management, in the level of capital at banks. You cannot do patchwork in order to get out of this problem. The cleanup of the financial sector has to be decisive, and you have to devote a certain period of time where that is your single-minded focus. You have to take a short-term pain in that time where you have to free up the fiscal resources. If you have to free up attention of the central bank, which is singularly geared towards cleaning up this financial sector over a 12 to 18 month period, so that when you come out, there will no longer be any questions raised about the stability of the financial sector. United States, in spite of its spectacular bank failures, in the end undertook this decisive recapitalization measures. In fact, US banks right now are above the Basel capital requirements because they are holding capital for extreme stress scenarios, which are even more aggressive than what the Basel capital requirements are requiring them to calculate. That would be a way, in my opinion, of securing India's long run growth. We have to take some short term pain. We can't always be focused on the next 6 months and the next 12 months of growth, because a country becomes great not by growing well over 1 quarter or 2 quarters. You do that by growing well over a 10, 20, 30-year period. So I think we need to do the cleanup. All evidence suggests that economies such as Europe and Japan didn't clean up its banking sector in 90s. Europe didn't clean up its banking sector after the global financial crisis. They are stagnating. I don't think that's the long run growth trajectory that we want to be on.
You spoke of structural reforms that we need to go in for right now. And then you, of course, mentioned privatization, an aggressive form of privatization and recapitalization of banks. But besides these two, what would you suggest that India goes in for in the next 6 months to 2 years in order to not only to be able to get over the hump of this slowdown of this recessionary trend that we are witnessing?
So what we need to do, and this may seem paradoxical, but I think reform is the only way to go, is that at the one end, we need to create short-term extra space for expenditures. We do need to borrow more in order to do that, because as I was saying, the tax collections and revenues are actually coming down. Now, why would the markets provide you extra debt without increasing your costs of borrowing significantly? They would do that if they have credibility, one, that the expenditures that you undertake will resuscitate growth, and two, that you have credibility to commit to a path of consolidation down the line. The way you build credibility that this expenditure is going to lead to long run growth is that it has to be spent on infrastructure. It has to be spent on creating ease of doing business in India on a variety of fronts. Maybe it requires special economic zones. Maybe it requires a Mumbai-Delhi industrial corridor. Maybe some thinking has to be given as to what supply chains out of China and certain other parts of the world can be moved to India, and how do we actually create business-friendly, market-friendly conditions for these entities to come in, set up their plants, factories, and help create high quality jobs in the country.
What was your feeling when the government invoked Section 7 of the RBI Act? And what was the feeling within you as well as other officers in the RBI? How did you feel about it?
I try to remain fairly dispassionate about these things. I understand that governments have their own pressures. They come from a variety of short-term demands that they may have imposed on themselves, or they may be coming from various constituencies. My thinking on it is very simple. The Section 7 was to be invoked if there was a consultation, but a disagreement that was that led the government to think that it was in public interest to invoke Section 7. So my view is very simple. If you think it is in public interest, you need to articulate what that public interest is. And therefore, in my opinion, the A.D. Shroff memorial speech. I think if you are invoking Section 7 because you have some disagreements and you want the central bank to undertake certain decisions, which the central bank seems resisting, then there has to be a public debate about these issues. On the one hand, we have been saying that the reason why our banking sector is in mess is because we had this excess of banks lending left, right, and center in the last decade. And on the other hand, in the midst of that cleanup, the pressures on us were to allow exactly the same thing all over again. We thought it was not in public interest. And as public servants, and as given our understanding of the legal mandate of the RBI, the only option left on the table for us was to actually have a public debate about whether this is in public interest or not. And I'm glad we did it. I would do it all over again if I had another opportunity to do so. And I think there has to be voice when there is disagreement. Voice, dissent are very important parts of a country to get to the right decision making. And therefore, also, I think it was very important for me to write this book, to raise issues about the fiscal dominance and why they are stretching into every single part of the financial sector. Because if we don't debate these issues, which we are facing government after government after government, I think we will not make progress towards restoring the growth potential of the economy.
So if there was voice and dissent, do you think demonetization would have been averted?
Oh, that's a googly and it's outside the Ostem, so I'm not going to play it.
But what's your view? I mean, just as an outsider,
No,
do you think it served its
in general,
purpose?
my view is that there has to be public debate about these decisions. I think, in fact, in the preface, I actually say that when a central bank takes extraordinary actions which are out of its standard blueprint of how it goes about doing things, these extraordinary actions should be backed by publicly disclosed reports explaining why are we deviating from our standard norms. So, for example, if a regulatory forbearance is being given, why are we doing this? What do we expect the intended consequences to be? And what are the likely unintended consequences of adopting this policy? Those have to be laid out in a transparent manner for everyone to see, because that very process of being precise, of being asked to write a public document that's going to be vetted by everyone, would make you think twice, thrice, four times about what the pros and cons of taking an extraordinary decision are. I think that would be a very healthy discipline, in my view, on the central bank. I understand you have to act fast, but you also have to act right. And I think both of these things need to be given equal importance in the decisions of the central bank.
If you are asked to give a rating to the Reserve Bank of India as an independent, autonomous financial institution, what kind of rating would you give?
I would give it a very high rating, I think.
Despite all the experiences that you have had?
Despite all the experiences. I think it is an extraordinary institution. It has people of the highest integrity. They work really, really hard given the limited incentive compensations that such high pressure jobs require. And I think people underestimate the fiscal pressures which are actually permeating into the decision making of the central bank. I think when I think about the past governors and deputy governors, pretty much all of them, I think they have built truly a wonderful institution. I think the country should be very proud of what it has as its central bank. I think we need to strengthen it, we need to empower it, and we need to retain its autonomy so that it can continue to be the pillar it's not like, you look at the world around, it's not like Federal Reserve has not made mistakes. You had the global financial crisis. So just because things have gone wrong doesn't mean an institution is not right. Things do go wrong. I think the sign that RBI is a great institution, in my view, was that it made an honest attempt to rectify the errors of the last decade's lending excess. I think we made an honest attempt. We resisted the pressures that were coming on our way. And I have no doubt that if these sorts of situations arise, there will be a cadre within RBI that speaks up and provides the right resistance.